Alright, so today I'm going to try something new, and that's actually maybe part of a series we're going to do more often, and that's portfolio reviews of some of my subscribers. So I've asked you in one of my previous posts for those of you interested to send me your portfolios, and I'm going to do a video on it and share my thoughts and feedback with you all. So first off, thanks very much for those who send me their portfolios, really appreciate it. Obviously some of you asked to be anonymous and I'm not going to share any names, but I think it's interesting. I always like to see other people's portfolio, see their thinking behind it, how they allocate their money and where they invest into. So if you do enjoy these kind of videos, give the video a like, then I know I can do more of these in the future. So without further ado, let's start with the first one. And honestly, I was super impressed with that portfolio. It actually comes from a subscriber who's been supporting my channel for quite a while. His name is Ward, he lives in the Netherlands and he's only 18 years old. Yet he has a portfolio already that is much better than many elderly people. He himself actually humbly says, I haven't invested a lot yet, but try to invest every month and hopefully it grows bigger. Alright, so here we have his portfolio. Actually, he uses an app called GetQuinn, which actually is a free app that you can use to get a good insight and overview into your portfolio and investments. So it's really, really nice to get started. Honestly, as it is free of charge, it's great. Then again, you have to do manual import. Sadly, they don't auto-sync with a lot of brokers. So if you don't mind the manual import, I think it's really a great app that you can also have on your phone. So definitely, if you want a free version, GetQuinn is a great tool for that. Right, so when we look at this portfolio, you can see overall, he's already at 9,200 euros invested. I mean, at 18 years old, I didn't even have that amount saved in my bank account. And here, this young gentleman already invested. I mean, if he continues to dollar cost average into that, I mean, he'll be financially free well before his 50s. So really props to him for starting so early and committing to investing long term. So when we look at his portfolio, one thing is very quickly evident that he only invests into ETFs. So that's actually a good thing. If you don't want to spend too much time into stock picking, etc., then investing into ETF can be an amazing way to go about it. Especially when you're young, you have time on your side, you can have slow compounders, and he has some great ones in here. Starting off with my favorite one, which is the WUSA, the S&P 500 ETF from Vanguard for Europeans, basically, that follows the S&P 500. And he has here quite a bit of money in there already. It's a distributing ETF, so it means it pays the dividend out to you. So that's really good. Overall, I really think he's doing a great job diversifying his ETFs holdings across different providers as well. He's obviously using some of the biggest providers, such as Vanguard and BlackRock, which makes sense because I personally also wouldn't invest into a small ETF provider because there might be a lack of liquidity in the future. We don't know their track record. So going with one of those two big ones definitely is probably your safest bet if you want to invest in ETFs. Now, obviously in this review, this is just my personal opinion. I'm not a financial advisor, so I'm just giving my thoughts and feedback on those portfolios. And again, I'm not super familiar with all of those ETFs, but just looking at some of them, I can see already quite a bit of overlap over there. For example, the WUSA S&P 500 over here is pretty much the same as the IUSA, which is core S&P 500 ETF, which is the one from BlackRock. You can always go to the provider and then look for that particular ETF. You can click over here on holdings and then you'll see the holdings. And you can see here pretty much the same as the S&P 500 or WUSA holdings. Apple, Microsoft, Amazon, all the very same. If I then go back into the FTSE All World ETF, which is kind of a global ETF, which is great. But if I go into this over here, I can see the overview. That looks all nice. A low expense ratio. So once again, going with BlackRock or Vanguard usually have low expense ratios. But then if I click into portfolio data, I can see here, once again, majority of that is actually based in North America, a little bit in Europe, then Pan Pacific, and then emerging countries, only 10%. Obviously, you can see here, United States by far the biggest. And when we come to the holding details, once again, you see pretty much all the same companies. The biggest one being Apple, Microsoft, Amazon, pretty much all the ones from the S&P 500 making up the majority of your ETF holdings. Another one, when I look at the MSCI World Technology ETF, WTCH, never heard about them before. It's apparently from State Street Global Advisors. And when I look into the geographical weights over here, once again, it's 88% USA, and the top holdings here are actually 22% in Apple, then Microsoft, Nvidia. Obviously, these are all tech holdings. Then you have a good one from Europe, ASML from Netherlands, but that's only 2%. You can see the huge weighting on US tech stocks. So if you would add up all the Apple holdings from all those portfolios, you would have a massive chunk just invest in Apple basically. So maybe that's the way to go. But personally, I think having an ETF, you're already diversifying. Now having so many different ETFs to diversify from the diversification, you're almost over diversifying while still coming back to similar holdings. So maybe it makes sense to reduce some of them to really go through what you want to achieve. I definitely think you should go with the S&P 500 because that's just a core holding. And as we saw, majority even of emerging markets are having core holding from the US. But then maybe you want to have a purely emerging market ETF if you want to capitalize on future growth from emerging markets that has much less weighting on the US and really heavily goes after emerging markets, Asia Pacific, etc., with less focus on US, so you can really balance it off. Otherwise, you're kind of adding 5, 10, 15% maximum of emerging markets, and the rest is all based around the core US, which is nothing wrong. I mean, myself, I'm mostly investing into US stocks because I see the future there. I know I'm getting transparent news from there, much more than maybe from India or China. So I definitely trust those numbers more, and that's why I invest mostly into US. So if you feel comfortable with that, that's great. But then I really think you can trim down some of your other ETF holdings and then focus on 1 or 2 ETFs, maybe another emerging one. And later on, you can always add some stocks if you wanted to find individual picks, or if you really want to go after dividend growth, because for dividend growth, I'm not a big fan of ETFs, especially for Europeans. The ETFs we get over here with dividend growth are not that great. So then I would go, as I do myself, for individual dividend growth stock investing, but the choice is yours. But you can see over here starting to get some dividends, and obviously that will snowball and grow over time. But really, Ward, great job, well done, and keep on investing. The next portfolio is from a gentleman called Anto. I don't have details, he just sent me a screenshot of his holdings, which is totally fine. So I don't know the background story, how old he is, whatever, but he did send me his portfolio, which I appreciate. So let's have a look. So it looks like he's also using the app GetQuinn on his phone as an app, and just did a screenshot from it. Obviously you can see here he has aggregated portfolio and then individual, some stocks in Revolut and some stocks in interactive brokers. Pretty much the same how I started investing, and then moved all my stocks from Revolut, where I started with, and later on transferred them into interactive brokers. So let's have a look at his holding. Same here, his biggest holding is the VUSA S&P 500 ETF, where he has $4,700 invested in it. And honestly, if you're European wanting to invest into the S&P 500, going with the VUSA ETF from Vanguard is also my personal choice. It has the lowest expense ratio. It has arguably one of the highest liquidity of all ETFs in Europe, and has really been tracking well the S&P 500 over time. Plus, it's a distributing ETF, and I personally just prefer distributing ETFs because I can see the dividend coming in. Obviously, I reinvest it, but later on, 20, 30 years from now, I can actually use that money and live from it, right? I don't have to sell my individual shares. If you have an accumulating one, then you would have to eventually liquidate some of your shares to then use the funds to pay for your living expenses. Here, you're actually going to get paid a dividend, which I really enjoy, and you can use that money to do whatever you want to. So great job over there. That's his only ETF. Then he goes into some individual shareholdings, which is always good to see. So his biggest position is actually in Tesla, which personally, I'm not a Tesla shareholder, even though I wouldn't mind driving a Tesla one day. I really like the technology about it, not so much the aesthetics about the car. A lot of people say obviously Tesla is not just about cars, but also robo cars in the future, self-driving cars, battery, power, AI, so many components that are part of Tesla. So the long-term opportunities for the company are tremendous. I just think personally right now they're overvalued when I compare them to other companies, even though people say you can't really compare them to other companies. But I assume the gentleman is still rather young. So honestly, investing some of your funds into Tesla is probably not a bad idea, because I don't see them going out of business anytime soon. And 5, 10, 15 years from now, they might be worth 3, 4, 5 trillion dollars. So you might have a huge upside over there. So if you're not nearing retirement, then obviously putting some of your money in Tesla to have a bit of a growth stock play over there, I think nothing wrong with that. His next stop is a REIT, a real estate investment trust, which is called Vici. I really like that REIT. They basically hold majority of all casinos and hotels in Las Vegas. It's a massive company, really interesting. If you haven't heard about, do some deep dive analysis. I might do a video on them very soon. I haven't invested into them yet. I find them a little bit expensive at the moment, but I'm really keen to buy some shares in them very soon, because they pay actually a very nice dividend of around 4.5%. And I think the long-term growth for the company, as they're trying to expand outside of the US also, is quite big over there. Then we go to one of my favorite holdings in my portfolio as well. It's Realty Income, which is another REIT that holds real estate in US and now also venturing out of the US. And the great thing here is they pay a monthly dividend, which is always nice to see a dividend coming into you every single month. It's also around 4.5% at the moment. So going with Realty Income, they've been actually growing the dividend for the last 26 years. So really a proven track record, and you can't really go wrong with them. Then he owns some Starbucks, and honestly, I always go back and forth between owning Starbucks or not. Well, first of all, their coffee. I don't particularly like their coffee, but then again, I still go to their shops when I'm in other cities because I know what I'm getting, and I usually like the atmosphere. There is always a nice buzz inside. Now, when it comes to investing, I'm always in between if I invest in them or not. On the one hand side, I really like the brand, and they obviously have a great brand power that is known internationally, but in the last earnings call, when I listened to it, they had so much reliance on China, because if China was to crack down on foreign-owned companies, for example, they would lose a huge chunk of revenues, because in many Western countries, they're already so saturated. I mean, how many Starbucks can you have on one corner, right? So if you go to any big cities in the US, also Europe, you see so many of them. So the organic growth there is very little compared to their footprint in Asia and China in particular, obviously, where they would still have a lot of room for growth. Now, some of the things holding me back is on the one hand side an upcoming unionization where they want to start unions in different coffee shops, which, for workers is a good thing, but for a company that can kind of limit their pricing power, their expenses, their creativity. So I'm usually not a big fan of unions. So if that was to come, that might kind of hold them back a little bit. And Howard Schultz, the previous CEO, was really pushing against that and did a good job. But now that there's a change in CEO, I don't know where they're going to go and how they're going to do. And secondly, their product offering is pretty much just coffee, right? They're adding obviously new things all the time. But overall, I prefer companies like PepsiCo or Coca-Cola that have different beverages, different food items, etc. And they're just more diversified. If you buy Coca-Cola, you also own Costa Coffee, which is another coffee brand, part of Coca-Cola. So they're more diversified. Here is just Starbucks. If they end up with a bad PR campaign against them, all of a sudden people might buy less Starbucks and their revenues will drop. So while I like the company, personally, I'm not going to invest, but I understand people who do. And obviously it's not the biggest holding of his, so it makes sense. They pay a nice dividend, so definitely nothing wrong with it. Then of course he has some Apple, which should be in every good investor's portfolio. I mean, it's the most valuable company in the world. They've been growing so well over the years. Myself, I'm an Apple fanboy. I have all their products. I love the company. They are a technology company paying a dividend, so there's really not much more to add over here. Great company, keep on investing in them. Then he also owns some Microsoft. I really don't like Microsoft for my personal use, but when I look at them objectively, the things they have done in recent years, buying LinkedIn, gaming companies, ChatGPT, cloud computing, and so many other things, they're really on a great trajectory. And I wouldn't be surprised if one day they might actually outgrow Apple. On top of it, they are paying a dividend, unlike Google, for example, and have been growing that nicely over the years. So holding some Microsoft in your portfolio probably is a pretty smart thing to do. And as the last holding is Qualcomm, a company I'm not too familiar with. I only know that they used to manufacture the modems inside the iPhones around the world, but apparently Apple has dropped them. That's a hold of around $9 billion. So definitely they dropped quite a bit of revenues, but obviously they're also working with other manufacturers. So I'm sure long term they're gonna be okay. As you can see over here, over the last 10 years, the S&P 500 returned 210%, while Qualcomm only returned 127%. So for me, not a company I would invest in, but I understand if he does. So overall, great portfolio. I like that his majority of his holdings are in an ETF. So he is diversified and a bit more secure, while at the same time having a smaller amount of his holdings in some growth stock companies that really have big potential to grow in the coming years. So really well done and keep on doing what you do. Next up, we have another portfolio from a subscriber who asked to remain anonymous, but he did write me. He's a new investor. He has a small portfolio. He hasn't been actively investing until he saw my video, as he didn't know which strategy to choose. But after watching my videos, he started going with a dividend growth stock investing strategy. And he's planning to invest around $300 per month. Well, first of all, I really appreciate the honesty and really makes me happy to hear that I inspired you on your investing journey. Right, so that's his portfolio. Obviously, he's using Interactive Broker, so well done on that. That's definitely also my broker of choice. And I really think for growing it long term, it's probably the best options. Once again, especially for Europeans or non-US citizens, I really think is the best broker out there. Now, as he said, currently his portfolio is still small as he started around $1,000, but still good to see how he's allocating his money. So let's go through one by one what he's holding. Starting off with Amazon, where he holds 11% of his portfolio in Amazon. And honestly, you can't really go wrong with Amazon. Now, obviously, those kind of growth technology companies, they go through cycles, right? They're obviously right now in the downturn, but obviously situations and macroeconomic factors will change. Interest will come down. Eventually, those companies will be able to borrow more money at cheaper interest and start growing their pipeline, their growth, their sales again. So you can't really write off Amazon. So there's nothing wrong in investing in it. I think definitely well done over there. They're not paying dividends. That's fine. You don't have to have only dividend growing stock companies. But if you said that you want to go into dividend growth, then you might want to hold off to invest too much into Amazon because obviously they're not paying you a dividend. Then we have another non-paying dividend company, which is Google or Alphabet. And I also have them in my portfolio. A huge technological company. They're obviously now going after AI as well. So I think there's so many opportunities. So you can't write off Google, but keep in mind they don't pay a dividend. Then a very interesting choice of owning Interactive Brokers shares. Maybe he got them as a sign-up bonus, etc. I don't know. But personally, I'm not investing into Interactive Broker shares. I love the broker itself, but I wouldn't necessarily invest in the platform. The yield or dividend is very tiny. I think it's 0.5%. And I just know the margins for online brokers are so low with the world going towards commission-free trading that I don't really think they're going to massively grow and scale their business overnight. I think they're not going away, but would I actively invest into the broker? No. But having looked at the performance over the last 10 years, they actually did manage to outperform the S&P 500. So well done to you and keep on investing if you like the company. Then we have J&J, one of the 3 companies in the world that are AAA rated. So Johnson & Johnson, a pharma company that's not going anywhere. I hold it myself. It's a dividend king, having increased their dividends consecutively over a 50-year period. Then he's also holding some Coca-Cola. And as I said before, you can't really go wrong with Coca-Cola. One of Warren Buffett's biggest holdings. They own so many different beverages. They want to be known as a total beverage company, from coffee to energy drinks to waters to sodas, starting to add alcoholic drinks. I made a whole video about Coca-Cola, why I love the company, and definitely it's a great pick. So definitely keep on doing that. McDonald's, another fantastic company. I personally don't own them yet because I think they're a little bit expensive for me at the moment, but I will definitely invest into them in the future. They're not only selling burgers, but it's actually a real estate company because they own a lot of the plots around the world where they are franchising to their franchisees. A huge, massive brand presence. And personally, if I had to choose between McDonald's and Starbucks, I would probably go with McDonald's. Then he owns some Nvidia, and that's also a very smart move to have a long-term growth play over there, because obviously we see the situation and battle between the US and China. Nvidia is really going to capitalize on that chip shortage. They're heavily pushing and working with AI. So I really think a couple of years down the line, Nvidia might be significantly bigger than it is right now. Then he also owns some Tesla, and I spoke about Tesla before. While I personally don't own it, I do believe in the growth portfolio. If you're still young and have many years to invest, then definitely some part of your portfolio can be invested in it. Obviously, they also don't pay a dividend, but not everything has to be a dividend paying company if you also want to invest into growth. Because often investing into dividend growth, some of those companies, they might not have the highest price appreciation because they're more established companies, while non-dividend paying companies often reinvest a lot of their earnings into research and development, and this way they can faster grow their portfolio, their growth, their revenues, their profits, and have a faster price appreciation of the share. So it's really something you need to ask yourself what you want, dividend growth or share price growth. One is not better than the other. It's just something to keep in mind. And lastly, I'm really happy to see he also owns some good old VUSA, S&P 500. You really can't go wrong with it. He has a good portion of his portfolio invested in it. So definitely keep on dollar cost averaging into that ETF. It's not going to go anywhere unless the USA collapses overnight. But if that was to happen, I think we all have much bigger problems to worry about. So honestly, amazing portfolio. Really like how it's composed. The only thing I would ask you to reconsider, as you said, you want to go after dividend growth investing. A lot of your stocks are not actually dividend growing stocks. Even some of the companies are not paying any dividends. So if you understand that and you're fine with it, totally fine. Otherwise, you might want to add a few more dividend kings or dividend aristocrats that have a track record of growing their dividends over the years. But apart from that, amazing portfolio. And the last portfolio review for today comes from Marcos, who shared this portfolio with me on our Smart Money Club group. And if you haven't joined yet, click in the link in the description below. It's free of charge and we'd love to have you around in the community. He's using a tool called thedividendtracker.com, which is great. Obviously visualizes your portfolio. So I don't have a background story about his portfolio, his age, etc. But I can see over here, it's a fairly small portfolio, $111. So I don't know if you just started or hasn't updated all of it. So it's a little bit hard to comment, but I just want to share with you one observation right away. First of all, it's way too many holdings for such a small amount. So once again, I don't know if you're just playing around with it to see how it goes. But for me, having so many holdings for a $111 portfolio, it just doesn't make sense. He's having 49 holdings. For me, it's way too much. Honestly, you can't stay on top of all of them, read their reports, listening to the earnings call, see what's happening. I just don't think it makes sense. Then better have 1, 2, 3 ETFs, as you saw in some of the earlier portfolios, and then add a couple of individual stocks that you can track and follow. But having so many individual companies, for me, just doesn't make sense. And another thing for me that just doesn't make sense is having a yield on cost of 11.9%. Basically, his dividend on cost, which sounds amazing, but personally, I just think it's too good to be true. And when I see the dividend yield of some of the companies over here, I mean, it's just absolutely high. For example, EFC.US has a dividend of almost 15%. Sounds amazing, doesn't it? But if I actually go over to Seeking Alpha, where I usually do my stock research, I can see here the company and ticker symbol. But when I compare the total returns, meaning with the reinvested dividends of 15%, which is really high, obviously, and look at it at the 10-year period versus the S&P 500, I mean, S&P 500 in 10 years returned a total of 210%, while that company only returned 8.4%. And that comes from the fact that obviously the price, as you can see over here, actually dropped by minus 53%. That's why for me, I really don't invest into anything over 5%. I have one company that is Ultra that has around 7.5%, but that's already an exception. And I wouldn't invest a lot of money into this. The rest, I always try to keep below 5%. Even 4.5% is already quite high. Anything over 10%, there must be a reason why a company pays such a high dividend. And usually the company is coming to the end of the life cycle or has some other major issues. And that's why looking at most of his holdings over here, I would personally invest into hardly any of them. And there you have it. Let me know in the comments if you enjoyed this kind of video. And also do feel free to send me your portfolio to have a look through and potentially review it in one of the future videos. Thanks a lot for watching. If you enjoyed the video, please give it a like, subscribe to the channel. It means the world to me. Next up, you can check out this video over here where I'm actually going to go through my own dividend growth portfolio. As always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.